A lot can happen to a portfolio over time. Recessions happen, global pandemics happen, market crashes and corrections can occur. For example, in 2008, investors lost over 50% of their investments in the course of 1 year, 52% to be exact. Imagine looking at your portfolio 1 year later and seeing that you've actually lost half of your total balance. That's enough to trigger even the most seasoned investor's pucker factor. The only way to alleviate this problem is to hit that like button and subscribe if you haven't already. Just kidding. But don't forget to hit that like button and subscribe so you don't miss an important video with financial content. Let's jump in. So it's important to get our portfolio ready for all market conditions, because despite what the market and the financial pundits might have to say, nobody knows what can trigger a financial meltdown, crisis, or correction in any given year, which, by the way, on average happens once every year. We get our portfolio ready by minimizing risk and maximizing returns as much as possible. If you stick with me to the end of this video, I'm going to introduce you to Ray Dalio and share his exact all-weather strategy so that you can implement this in your own portfolio. I'm going to share some of my thoughts and how I'm implementing this in my own portfolio. The question then is, how do we get our portfolio ready to manage risk and weather the storm? See what I did there? Ray Dalio, one of the greatest investors of all time you've probably never heard of. Ray has developed an actual blueprint to achieve unicorn-like returns while simultaneously managing risk. Ray's firm, Bridgewater, is managing $160 billion. When a guy like that says something about a balanced portfolio, we listen. He has answered the question that every investor has been asking from the moment we put our first $100 into the stock market. How do we minimize the risk of losing everything? He says that in order to minimize risk, we have to understand how much risk is associated with each asset class: stocks, bonds, commodities, etc. Now let's start with stocks. Stocks are 3 times more risky than bonds. So right off the bat, if we're looking for the greatest returns and the least amount of risk, we have to find out what to surround our stock allocation with. Because after all, stocks have the greatest potential for returns. Right? Remember, from October 2007 to March 2009, the overall stock market crashed 55%, while Ray's portfolio only went down slightly over the same period of time. The worst drawdown in the all-weather portfolio has only been a standard deviation of 6.9%. So what is the all-weather portfolio? And then we'll dive into the actual ticker symbols and how these work. Here's the asset allocation that Ray came up with for this strategy: 30% stocks, 40% long-term bonds, 15% intermediate term bonds, 7.5% in gold, and 7.5% in commodities. Now, the reason for each of these is because each asset class listed here performs differently in different market conditions, hence the all-weather portfolio name. He says that the following 4 things affect asset value. Number 1, inflation. Number 2, deflation. Number 3, rising economic growth. Number 4, declining economic growth. Based on these 4 things, Ray expects we can see 4 seasons of the economy: higher than expected inflation, aka right now; lower than expected inflation; higher than expected economic growth; and lower than expected economic growth. The 4 seasons of the economy. Here are some statistics for the all-weather portfolio as of October 6th, 2021. 7.76 annual returns for the last 10 years. You would have made money 86% of the time, so only 4 down years. The average loss was just 1.9%. The worst loss was 13.99%. Volatility was 11.28%. First, let's start with stocks. The all-weather portfolio has 30% in stocks, Vanguard Total Stock Market Index, VTSAX. Many say this percentage is way too small of a percentage in stocks. But remember, as we already discussed, stocks are 3 times more risky than bonds. The purpose of this portfolio is to protect against the downside and minimize risk while maximizing returns. So having a smaller percentage allocated to stocks means the portfolio isn't a bet on stocks alone. This is very important. Next, let's talk about the bonds in this portfolio. Fixed income. 40% of this portfolio is allocated to bonds, U.S. long-term treasuries, VGLT. These are bonds that mature at 10 to 20 years or more and pay a 2.18% dividend yield with an expense ratio of 0.05%. Also, 15% is allocated to intermediate term bonds, BIV is the ticker symbol. These mature in 5 to 10 years or more and pay a 3.05% dividend yield with an expense ratio of 0.05%. Bonds are an investment that pay you a fixed amount of interest every year. This is in large part why the portfolio does so well in bad market conditions. So 40% is dedicated to bonds. Lastly, the portfolio rounds out to 7.5% in gold and 7.5% commodities. 7.5% in gold. GLD. Expense ratio is 0.4% and no dividend. Now, a note on gold should you want to hold this in your portfolio. The price of gold has held its value over the long term and symbolizes value for thousands of years. Dalio says, "We have a situation now where we have too much debt. Too much debt leads to printing of money to make it easier to service. So all of these things mean that some portion of an investment portfolio should be in gold." Often gold follows the amount of money in the system, meaning money printing can lead to dramatic increases in the price of gold. However, in the short term, it can be very volatile. Gold should be an important part of a diversified investment portfolio because its price increases in response to events that cause the value of paper investments, such as stocks and bonds, to decline. And finally, commodities. 7.5% is in commodities, ticker symbol USCI, with an expense ratio of 1.1%. Commodities are a distinct asset class with returns that are largely independent of stocks and bonds. Therefore, adding broad commodity exposure can help diversify a portfolio of stocks and bonds, potentially lowering the risk of an overall portfolio and boosting return. Now stick around for a minute because I'm going to share why I prefer a slightly different approach than Ray's all-weather portfolio, and I think you'll find it helpful too. Now don't get me wrong, I by no means think that I know more than Ray. Actually, here's a quick note on Bridgewater, Ray's hedge fund. Ray Dalio is the founder, co-chairman, and co-chief investment officer of Bridgewater Associates. He started Bridgewater out of his two-bedroom apartment in New York in 1975, and under his leadership, the firm has grown to the 5th most important private company in the U.S., according to Fortune magazine. Ray has been an industry-changing innovator as well as an advisor to policymakers around the world. Ray has been called the Steve Jobs of investing by Wired magazine and named one of the 100 most influential people by Time magazine. He's also the author of a New York Times #1 bestseller, Principles, which I highly recommend you read. The book outlines his work and life principles, the foundation of Bridgewater's distinctive culture, and the cornerstone of his and Bridgewater's success. Ray and Bridgewater also recently published Principles for Navigating Big Debt Crises, the first public dissemination of their research on these economic events, which enabled them to anticipate the 2008 financial crisis. Ray is currently working on his third book, which will outline his investment principles. Now, here are some of my thoughts. Now, most of you that are watching this have probably under $1 million in assets. So this means that you're still in the accumulation phase of building your nest egg and building your wealth. After reading the book by J.L. Collins, The Simple Path to Wealth, my investment mindset has completely changed. And now I look at market drawdowns or corrections, which happen once every year on average, as an opportunity to leapfrog my way ahead by buying more shares at a lower price. In the accumulation phase of your investment journey, crashes, corrections are nothing to be afraid of. These are actually opportunities for you to get ahead. Keep in mind, Ray Dalio is managing $160 billion in assets. When you have potentially $64 billion, which is 40% of Ray's total assets under management, accounting for the bond allocations, you're going to get a dividend of $2.56 billion roughly annually. For the average investor like you and me, what in the heck do you need 40% in bonds for? Ray's portfolio is designed to manage risk. You need to determine for yourself what your risk tolerance is and what phase of your investment strategy you are in. I prefer to have a much larger allocation in stocks than just 30% in order to take advantage of market returns as much as possible while I'm still young and in my accumulation phase. I do, however, maintain a good amount of cash to take advantage of market drawdowns or corrections. Well, I hope this video was helpful for you. This is Ray's all-weather portfolio strategy. I hope you got some value from it. If you did, please like and subscribe so you don't miss an important video with financial content. Have a great day.